Okay, my name is Matt Corcoran, and this is my presentation on the exchange rate fluctuation and currency depreciation relationship. Before I start my introduction, I wanted to mention the main macroeconomic topics from this course that I will be discussing in this presentation, which include exchange rates, currency depreciation, GDP, trade, inflation, investment, growth, interest rates, monetary policy, and foreign currency debts. So, a little introduction here. The two main terms of my presentation. We have exchange rate fluctuation, changes in value of currency relative to another, driven by markets, political decisions, and events. As for currency depreciation, that is the decline in value of a currency relative to others. Now, my presentation is going to be about the relationship between the two, and the eventual chain of events that leads to negative economic events all around the world. So, some global context. Emerging economies are highly sensitive to external shocks or global financial shifts. Some examples of these shocks would be the 2020 global pandemic, a strong US dollar, and that's a point that I'm going to get to later, inflation and commodity price swings. So some key concepts here. We have the chain of events that is exchange rate fluctuation to currency depreciation to economic effects. Um, and here I'm going to get into exactly what those effects are and how exchange rate fluctuation eventually impacts trade, investment, and inflation. So, when exchange rates fluctuate, when one currency is valued above another, um, the currency that has a lower value, that local economy, is going to face higher import costs. While exports become cheaper for foreign buyers, imports are going to become more expensive, which is bad for consumers who rely on foreign goods. So, say you are a country that relies heavily on foreign imports, and you are an emerging economy, you are going to be hurt by, say, the US dollar strengthening. As for investment, currency instability scares off investors due to a risk of unpredictable returns. A weak or volatile currency equals less foreign investment and higher borrowing costs. So again, if you are an emergent economy and you are borrowing in US dollars or some other currency that is valued above your own, investors might be less likely to help you out, or they might charge you higher interest rates to guarantee a better return. As for inflation, higher imported good costs lead to higher overall prices, which lead to inflation. That higher imported good costs is a result of currency depreciation, as I mentioned before. So, implications for economic growth. The US dollar point. So, I was going to make my way around to the US dollar again. It is a really, really big deal, um, a bigger deal than maybe most Americans realize. Um, basically, um, many emerging economies borrow in dollars. When the dollar strengthens, it takes more of their local currency to repay that debt, making it harder and more expensive to service. A stronger dollar often means higher US interest rates, and investors pull money out of emerging markets and back into the US for safer returns, causing local currencies to depreciate if they do not believe that said economy would be able to give them a reliable or good return on their investment. Central banks in emerging markets may be forced to raise their own interest rates to defend their currencies. So this is my point about the interest rates here. Um, but higher interest rates slow down domestic growth and hurt already weak economies, resulting in less GDP um, being produced in these countries. Um, these tough borrowing conditions also often cause IMF bailouts for countries in need of assistance. And that is the conclusion of my last point there. So, real world examples. The first real world example that I have is regarding some countries like Ghana, Pakistan, and Sri Lanka. In the article that I read about dollar strength and global inflation, the strong US dollar is causing inflation in emerging markets, particularly those heavily reliant on dollar-denominated imports like food and energy. And this is made worse by local currency depreciation, which is an effect of the direct effect of the US dollar um, increasing in value, strengthening. As for debt and currency depreciation, depreciation of local currencies against the US dollar is driving up the cost of borrowing in dollars, leading to unsustainable debt levels and increasing the risk of defaults in countries like Ghana, Pakistan, and Sri Lanka. So that was a quick summary of that article there. As for real world examples for El Salvador had their president's administration had an interesting experiment making Bitcoin legal tender along with the US dollar, and it ended in failure. Uh, the impact of the Bitcoin experiment on El Salvador's currency um, basically showed investors that El Salvador was a volatile emerging economy to invest in. They had to be um, intervened with by the IMF, and to do so, they had to scale back their Bitcoin experiment, which basically demonstrates the risk of relying on volatile currencies and the importance of maintaining stable exchange rates through effective monetary policy. Bitcoin's fluctuating value caused currency volatility, which increased both the cost of imports for El Salvador and their debt. So basically, you know, do not make your currency a volatile one like Bitcoin, especially in a country where um, your digital literacy is low and where most of your citizens prefer to deal in cash. The last article I read was about Africa's mounting debt crisis. Severe African currency depreciation occurred in countries like Egypt, Ghana, and Nigeria that are facing steep currency depreciation against the US dollar, increasing local import costs and inflation. As for debt pressure, my point about debt pressure is Ghana and Egypt are struggling to work on large amounts of dollar-denominated debt as their currencies weaken, pushing them to seek bailouts from the IMF. Economic instability as currencies in African nations such as Ghana and Egypt depreciate, investment outflows accelerate, which makes exchange rates unstable and makes it harder for governments to fund basic subsidies and social programs. So my conclusion here, exchange rate fluctuation can cause currencies to depreciate, especially if the local economy depends heavily on imports. Uh, Currency depreciation triggers inflation, volatile currencies that deter investment, debt stress, and lower growth. And all of these are mentioned in my examples from the three articles I read with Africa and other emerging economies around the globe that are suffering from both the strengthening US dollar and their own um, currency depreciation that is, in many cases, a direct effect of exchange rate fluctuation due to, again, a strengthened US dollar. So thank you. I hope you enjoy my presentation and have a good night.